Okay, great. So we're gonna go ahead. Good. So first off, I'd like to just have Dave McKevitt. He's a senior consultant with us. I'm going to have him go ahead and introduce yourself and just briefly let us know how long you've been doing this and everything like that.
Great, good. Great to see a great turnout here. This is lovely. Yeah, my name is Dave McKevitt. I've been working with Silkin for about 38 years. I've been consulting even longer than that before I joined Silkin, working primarily with healthcare professionals, dentists, optometrists, veterinarians, chiropractors, nurse practitioners, et cetera, and the odd non-healthcare related business, like a couple of contracting companies, and a few other things. But been doing this for a long time.
Excellent. So let's go ahead and get into it. And as promoted, we will have a Q&A session after. So at that point, we're going to open it up. You can go ahead and ask any questions that you would like in regards to your practice, things you may have going on, or anything that we went over in the webinar. Good. So obviously, again, the topic is overhead costs, profit leaks, and what that means for profitability and financial stability. So with that, what is one of the first things that practice owners must have in order to limit profit leaks, have high profitabilities, financial stability, and obviously high value of their practice?
Well, there's several factors that they've got to be confronting, and I use the word confronting advisedly. Confronting means to just look at without backing off, shying away from, dodging, ignoring, neglecting. Just look at what's there. And so you need to have a P&L, and it's something you need to actually look at, ideally monthly, absolute minimal quarterly, but ideally monthly. You have to know what you're looking at. You have to understand what your chart of accounts is. Many of the clients that come to work that I work with have a P&L. Very often they don't look at it very often. When they do look at it and I go over it with them in detail, they don't know what a significant amount of it means. There are very often factors in the P&Ls that are duplicative or ambiguous, which makes it difficult to really get good value from what a P&L is communicating to you. So having one and really understanding it is critical, and then looking at it without fail every month. So confronting your finances. And along with that, you've got to know, what does it cost to run your business? Not as kind of a big guesswork, but what is your make break point? And to that point, Julia, you might explain a little bit. When we look at make break, we're not just meaning what it takes to pay your bills. We add a little bit more into that proposition.
Yeah, a couple of things here. And first, I just want to touch on the profit and loss statement. And with the vast, large majority of the clients that I'm also a consultant with Silkin that I work with, don't look at their P&Ls. They don't understand them. There's a $30,000 charge, and I go, well, what is this? And they're like, I don't know, right? Which is always, I can be empathetic in that it is a lot. There's a lot on profit and loss statements, and there's a lot of unknowns. And in the hundreds that I've looked at, none of them have been the same, right? Which is also a very interesting point, right? How do they get categorized? What are these charges? Are these expenses even where they should be? And so really understanding where your money is going and having the confront to look at it and then control it after that. I think you stated it very well, is a large part beginning point when we're talking about profitability and profit leaks. And then, yes, the make break point. This is also something that I think gets misunderstood or looked at in an incorrect way. When we talk about make break, we're talking about one, obviously, what is the cost to run the practice, your salary, your mortgage, your lease, all your expenses, your COGS, your cost of goods sold, things of that nature. We're also talking about, well, what salary do you want to make, or should you be making as the doctor, right? Because most owners are also the doctors. So what should you or do you want to be making? So you have those two factors. And then when we look at make break, we're adding an additional 21% to those costs. And that 21% are very specific, right? So first and foremost, we want the owner as the owner and not the doctor. These are two separate entities that you're the doctor and you're also the owner. We want the owner taking, and this is built up on a gradient, but we want them taking a 10% off the top, and off the top means your gross, right? So that's 10%, okay? We want to set aside 5% for taxes, right? Obviously, we all know we got to pay the tax man, and you just want to have predictability and money set aside so you're not at the end of the year or come March or October, if you're filing extensions, going, oh crap, where is this money coming from? I have to take it out of my profits, right? And then we have 3% to a business savings. So this is savings. This is for any potential legal fees that come up. This is for, any unknown expense. Maybe you get, unfortunately, into a lawsuit or something of that nature. You want to have this money set aside. And then we have the last 3% is going to be to business development and expansion. And this is where you're putting money back into the business that's going to make you more money. And so we treat these as expenses. These aren't just things that, okay, if we have enough, we're going to put the money aside. But when they're considered expenses, we know, having worked with thousands of clients, that whatever is thought of that the practice needs to make is what the practice will make. And so when you never consider putting these percentages and these monies out there as expenses, obviously there's a lot more to it, and there's a lot of work involved in workout. But that's one of the first things is you have to truly look at, like you're saying, confronting. What is the make break? Well, I want to make X amount of money a year, which you should be well paid for what you do. And then you're taking a percentage as the owner. You're setting aside for taxes, savings, and business and development and expansion. And so that's, as you said, that is the make break that we're looking at, that all practice owners should look at from a predictability standpoint.
That's great. That's great. That's well said. And the other point that you made, which I think is worth stressing, is that a business will make as much as it thinks.
One thing I know gets overlooked, because we ask the question in workshops that we do, and we ask the question to clients as we work with them, but what is the biggest expense for the practice, right? And the biggest expense for the practice, one of the most common response, like you just mentioned, is staff, right? Salaries, benefits, if you're offering benefits. Hiring is a costly event, right? So the importance of hiring good staff. But the biggest expense is lost income, right? Money that the practice should be making and is not. And there's a few factors that go into that, right? So what is the maximum income potential of your practice, right? And that's a very specific formula.
Yeah. If you don't know what your potential is, given the resources you've got, your resources includes your office space, your number of exam rooms or treatment rooms, the number of support staff you have helping you produce the production in those rooms. You have to know what your ceiling is, because what we often find is clients are way below the production potential given the resources they have to work with, or with just a few additional resources that may not even be very expensive to bring into the practice, they can greatly enhance their ceiling. So that's another datum that you've got to really confront and compute accurately.
Yeah, and I think it's sometimes we see that clients are working so much, right? Well, how could we do anymore, right? I'm working 12 hours a day. There's no way we can see more patients. We are at the ceiling, and they all think it's an expense point, right? But we know, and we have had tremendous success where it becomes with efficiency and training and having the right staff in the right places.
Yes, exactly. So you need to be able to know, are your staff, just as Julia just said, are they efficient? Meaning, are they being productive with the least amount of effort? Being productive doesn't mean that they're busy. It means they are producing products. So as a good manager, as a good executive, every staff member in the house needs to know exactly what their position produces as a product. Every hat has a product. You know, reception has a product. Many times I've asked a receptionist, what's your product? Well, to greet people and to be the face of the practice and make everybody feel good. Those are definitely important things. But what they produce, arguably, is a full productive schedule. That's both a science and an art. There are a lot of things that you learned how to do to make the schedule full in a productive way. And are they getting that product? Do you have a way of measuring whether they're getting that product or not? If they're not getting that product as efficiently as possible, there's either wasted time or there's time being spent doing things that they shouldn't have to do to get their product, because maybe they're getting things coming to them that haven't been done properly and they have to redo them, or things haven't been filed when they have to spend time digging things up. They're all different kinds of things that can create extra work that reduce the efficiency of the team. And the good manager also has a clean eye for those kinds of situations. We have a term for that. We call that kind of situation that's distracted and really kind of counterproductive, because it's not counterproductive, but it's adding time to productivity. We call that developed traffic, meaning just that extra traffic that doesn't have to be there in order to get your product. And cultivating an eye to dev T is one of the ways that you increase the efficiency and productivity of your staff. It's one of those ongoing kind of radar, always going and looking for the dev T in your practice. And when you spot it, you nail it. And usually you find that it exists because somebody's not doing all of their job the proper way. They're not following procedures exactly the way they're laid out. Or maybe your procedures haven't even been laid out very exactly. Or if they have been, they haven't really been well trained in it. And when they flub, they're not instantly corrected and brought back to battery on the proper way of doing it. So part of the ideal scene of a practice is making good profitability and a lack of lost income, because dev T is also lost income, because those people who are spending half of their time dealing with dev T are producing half as much as they could be producing.
Right.
So that other half is lost income.
Right.
So that's one way you tighten up on how productive and efficiently so your staff are, so that you enhance your bottom line.
Yeah, and a great example of that, I have a client who's a vet, and I think been with us for a few months at this point in time. I want to say 7 to 8 months, and very bright owner, extremely bright, has 2 practices, and didn't have the policies and procedures and the trainings in place, right? And really just, and this is straight to profitability and staff efficiency. Put them in fast, ensure that every staff knew what they're doing, had all of their policies laid out, all of their procedures put in writing, and started putting them in place, right? And her profitability has doubled, and just continues to go up. And it's not necessarily that they're seeing more patients in one of the practices, but the efficiency level, right? And ensuring that when a patient is seen, best medicine is actually fully taken up. It's the thoroughness of it, the quality of care has really come up. And it was astounding to see when she shared that with me. Because it can happen very quickly. And we always, I think, tend to think about money in just terms of money. Okay, so what's finances? What are we charging? What are we paying in expenses? What am I paying my staff? But a large part of it is the efficiency, is the productivity level and quality of the staff, like the point that you just made on that.
Yeah, so having a good, clear concept of what each person is supposed to produce, ensure that they know exactly what they're supposed to produce, and having a statistical way of monitoring that. Not so that you're looking over their shoulder, though
Right.
you do that for supervisory purposes too, but so that they can control it themselves.
Right. Right. I don't want to be micromanaged, right? That's always
No,
the term, which is very true. Yeah, I don't want to be micromanaged either, right? But
no.
a measurement of production is key.
Yeah, it puts them in control of it themselves. They are charged with getting that product, and it's going to be reflected by the stat if it's an accurately assigned stat and defined. And there you go. Over to you.
Right.
We're counting on you.
Right. Yeah. And another great way to look at profitability, right, and how to increase it and like what your numbers really are, which I think is a great exercise for any owner of any business to do, is you want to do this. There's two aspects to this, or two parts to this. One is you have to understand your hourly cost, right? So if you're open from 9 to 5, right, what is your hourly cost? Meaning all of your expenses, so you take your make break numbers, which includes that 21%, right, that we added, and how many hours a month, a week are you open, right? And what is that hourly cost, right? And then you have to look at, well, what is the profitability and the cost? So you have to look at the cost of each service or product that you're providing, right? What are you charging and what is the profitability margin percentage for each of those? And that really is eye-opening, because if you want to be at a 25 to 40% profit margin, well, the only way you get there is if you're profitable in your services and products that you are providing to someone, right? And so really breaking it down and confronting the nitty-gritty of it all and going, great, well, where are we? Well, shoot, I almost said the other word, so I apologize. We're at 11% profitability. Well, that's not, we know, having worked with, practice owners, that there's a much higher ceiling, depending on what specialty, what field you're in, but you need to be upwards of 25, if not 40, even higher percent profitability margin. So then you have to look at, well, why is it costing you that much? Is there dev T? Are there holes? Are there flaws in the flow lines? Am I just not charging enough for fear of not being able to close or sell or turn away clients? And obviously you're going to have higher profitability margins in different areas, right? And so there becomes this balance, this average, but I've recently done that with a client, a new client, and it's just, you could just see a couple things happen. One, the relief of like, okay, good, now I understand. Now I know I'm not in confusion. I don't think anyone's stealing my money, because I don't know where all the money's going. But then it's like, oh, well, hot damn, we got some figuring out to do. We really got to sit down and look at this and confront it. And I think the confronting this sometimes is the uncomfortable part, where people want to jump ship. I'll just make more money, which is fair.
And confronting it also in terms of having control over your finance includes having system of finance and paying your bills that isn't just, well, I'm going to pay them when they come in, or as soon as I can when they come in. I mean, there's a systematic way of sitting down like on a once a week basis, and you look at all the bills you have owing. How much money do we have? And there's a whole systematic way that we teach our clients on how to sit down and do the FP, do the financial planning. And it makes you, it puts you in a viewpoint of being in control of it instead of chasing it. You know, if you're chasing it, it's kind of running you.
Right.
And when you sit down and you examine the whole big picture, knowing what your full make break point is, knowing where you are relative to your target, where you should be, knowing what your expenses are, it helps you direct your attention into whatever parts of the production machine need to be addressed to tighten things up. And I use the word production machine also advisedly because in our consulting, we have 6 major systems in a practice that need to be firing on all cylinders. Analogous to a car. A car's got a system of tires, of braking, the engine, the drive line, the body of the car, the cooling system, the electrical. All these systems have to be working optimally for the car to be most efficiently getting down the road. Quite analogous with that. Your practice has 6 major systems, and there's another 4 minor systems beyond that each one needs to be firing. Part of why you're not profitable might be your sales system. Maybe you're not selling efficiently. And that's something you can measure statistically and monitor. And there are ways of addressing that put you more in control of becoming a more effective, in healthcare practices, we hate to say salesman, but you get much better treatment acceptance. You're not selling something the person doesn't need. They need it, or you wouldn't be recommending it. But if you can't effectively convey that to the person, they're looking at dollar signs, and maybe they're not accepting treatment that they should be. So being aware of all those systems is another way of increasing your control. And we have a basic motto that we live by, which is control equals income.
And having equals control.
And having, meaning they know what they're doing, the staff know what they're doing. Yeah, equals control. So these things wind up all being of a piece and weaving together for an integrated set of systems that are generating the highest level of profitability. And mainly what we've been talking about is the finance system itself.
Right.
But it's not completely divorceable from the personnel system and efficiency, production and efficiency, from sales system, marketing system, and these other systems. If you have an ability to analyze out the systems in your practice, then you can better determine where you need to put your attention to get the kind of control that you need over your practice to really generate the kind of profits that you would like to have.
Right, absolutely. And talking about financial stability, right, is if you have that control, the financial planning, the predictability, we know the schedule ties so directly tight with the finance system, right? Because you can't make money from them if you can't see them. So what does your schedule look like? Are you, do you know what your production needs to be from your schedule every day, gross and net, right? Things of that nature. So again, having that knowledge and that control, right, equals income. And then putting all of that together is the financial stability point, right? So the last topic here is practice value and how these things tie into practice value. So there's obviously several ways that practice valuations happen, that the value of your practice can be measured. And so I'm gonna let you speak on in terms of the valuation and what the profitability means. And then I'm going to show an example of the different profitability margins, which are in your control, and how that affects ultimate value sale of your practice. Because as practice owners, this is your probably one of your biggest, if not your biggest investments, but it's also your greatest liability. And you want to make sure that it's sustainable, it's stable, right? So go ahead, Dave.
Yeah, well, the value of your practice is something that every one of you should be aware of, what it is now, and what you want to work it toward being for transition. Our viewpoint on transition is not something you do within a year or two of when you're wanting to retire or move off the lines to a certain degree. It's something you should be looking at when you start the practice is the point at which you should be looking at transition and laying out kind of a game plan toward how much value you want to have in your practice and how you're going to get there. So the valuation of it should be determined at least once a year and looked at. And there are formulas with which you can do that, or you can have somebody, a professional person, help you determine what that valuation might be. Anyway, Julie, was there something else that you had in mind?
So I'm going to show you an example here. This is something that we show clients in through different scenarios. Now, understandable that from profession to profession, area to area, your multiple is going to differ. Things are going to definitely differ. But the point here on this slide, you can see my screen, Dave?
Yep.
Great. The point here on this slide is talking about the difference in the profit margin and the difference in the value of the practice. So you have a 15% profit margin, right? The value is this potentially, right? On a 3 to 4 multiple, right? When you increase that profit margin by 10%, 25, which ultimately for anyone should be the bottom line, you drastically increase the value. Sorry, that should be a comma and not a period. The value of the practice. And then here at 35%, again, it almost or basically doubles in value. So that's really, when we're talking about profitability, we're not just talking about the present, but we are talking about the future and what it can do for you for your practice as a whole. And so we just want to make sure that we tie all of these points together. Overhead costs, right? What does it look like? Where are they at? Do you know your industry standards? Profit leaks. How much money should your practice be pulling in? And if it's not, where are the leaks? Profitability, right? We talked about that. How do we get there? Where do we want to be? Financial stability, a lot about financial planning, having control over income, over your different systems, and then practice value. Again, understand that it varies also time of year and all these different factors, but understanding that the higher your profitability margins are, the higher the value of your practice that someone's going to want to purchase it for. So, great. So those are all the points. At this point, we'd like to open it up for anyone who has any questions. You can go ahead and put them in the chat, or you can go ahead and take yourself off mute, and we would be happy to tackle them. Any questions? Comments? I am going to put, oh, here we go. Good. So you mentioned a formula on calculating profitability per code. Can you share that formula? Yeah, basically, I'll just per code. So are you talking about per service is what I'm going to assume. but the basic formula is, what does it cost you, right? So going back to, what does it cost you per hour, right? So let's say it costs you, I don't know, $1,000 per hour that the practice is open to run. Great. So how many rooms, how many chairs do you have, depending on what profession you're in? So then you have to divide that by the number of rooms, the number of chairs, right? So then you're going to get your per hour cost per chair per room. So then what you do, so you know that's what's going to cost. So then let's say you bring a patient in and they're coming in for an hour appointment. So you, at that point, know what that cost is for that hour to see that patient. So then you take a look at, great. So let's say it costs you $250. Okay, good. So now what are you charging? So then you take what you're charging and you minus the expense, and then you have the profit, what the profit is, and then you just calculate it for the percent of profit. And so what I'll do is post the webinar. I'll go ahead and send that out to everyone in case you're curious. I'm going to take up this next question. Did I answer that question, Gabriella? I apologize. Great. Good. So one thing that we do offer before I take up this next question is we do a completely free practice analysis. It is completely free. There is no bait and switch here. And you get with our senior analyst. His name is Alan Jackson, who's been doing this for 30 plus years as well. And we start to take a deep dive into your practice. What's going on? What problems are you running into? So you're able to get answers and solutions right away. Okay, so in the chat, I put a link there for you to fill out a form if you are interested. Okay, good. Beth, you asked, will we be able to get notes/proceedings from today's session? Yes, I'll go ahead and I will send the replay. Feel free to share it with any colleagues or friends as well. And then I will include some notes that we went over on it. You are welcome. Any other questions? These are great questions. Money's always a good topic. While people are thinking, Dave, anything you want to share?
No, we've covered a lot of stuff. I would just kind of underscore, if you don't understand your P&L, take the time to understand it. Sit down with your accountant or bookkeeper or whoever's helping you with that. Help them define for you so you have an exact definition of every item on there. You know what you're spending money on, and you're going to find that there are confusions in the P&L. Unless you've already done this, unless you're that on top of your finances, you're going to find things in there that don't make sense, or they're misassigned to the wrong category, all kinds of things. But having that picture of what's going on is a critical way of confronting what's going on with the outflow of your money, which you definitely want to be in control of. One of the principles you always want to be applying as you look at the finances of the practice is you want to make it really easy for the money to come in. You want to make it kind of difficult for the money to go out. So nobody's got a practice credit card that they can use on whatever they think they need. No. Or if they do, it's set with a limit that's within the budgetary limit that's been established. Anyway, I just underscore that point.
Sometimes you got to get those points though, Dave. You got to get those Southwest or credit card points. No, I'm just kidding. Good. Yeah, it's a great point. Make it hard to go out, easy to come in. Good. The next question, could you include the industry standard overhead and P&L chart of accounts to organize properly? I will include some information on that. Yes, Todd.
And it can vary by kind of practice. So, Todd, what kind of practice do you have? and we can get the most appropriate one out to you.
Well, we'll send I can include some information for the practices. Oh, general dental, but airway and ortho. Okay, great.
Oh, airway, good.
Nice.
That's good stuff.
Could have some good profit margins in those industries. General dentistry for David. Okay. All right. Any other questions? We will be doing these on a regular basis, pretty much weekly. We will include our future ones. Make sure that you get some information on that. Feel free to share it with anyone you know that would find the information useful for them in their practice. Also great for office managers. If you have an office manager, this information we find very valuable, so you want them to run as CEOs, right? And so the more information that they have on the holistic view of a practice, typically the better managers they're going to be. Okay, so if you have office managers and you want to share this with them as well, it's a great idea. Paul, I saw general dentistry. Thank you. Go ahead, Dave.
No, that's great. That's a great point that you just made. Relative to office managers.
Thank you. All right. Any other questions? All right. Well, thank you very much. Again, I will send an email out to all of you with the replay, with some information that you requested. Also with a very short survey, if you wouldn't mind just filling it out, that would be great. Dave, thank you for your time, your expertise, your commitment to ensuring others meet their goals and purposes with their business and life.
Thank you, Julia. Great.
All right, everybody, take care.